Imagine I had to jump off that plane and build my parachute on the way down. That's what doing a startup is. More businesses die of and starvation, so you don't get frivolous. Constraints lead to creativity. What shocked me the most is InVision. I had been using InVision for UX. They raised at 1.7 million and they got the email last week that they're shutting down the product. Any industry where there's a pot of gold at the end of the rainbow and everyone's chasing it, there's just also going to be a lot of bad apples and scams. When a great salesperson meets a great network, magic happens.
This is more of an American thing because there's business idols, especially to America, right? Where we like worship Elon Musk, right? And talk about Jeff Bezos and Mark Zuckerberg like in news headlines, like it's gossip.
Just do yourself a service and run your business, get more customers. Now, the worst is going on a journey where you know you're going to get a bunch of no's. It's like, I'm going to hit this club, which is all a bunch of supermodels, but I know like everyone is going to tell me. So I'm just going to go and set myself for disappointment. You build a business to deliver value to customers, shareholders, and employees, not you first. And if you can't go on that journey, then just know that you are a scammer.
Venture capital, golden ticket, or giant Ponzi scheme? What do you think, Lloyd?
Who wouldn't want a piece of that magical money showering pie?
I mean, let's rewind a bit. How did this whole VC madness even start?
I think it was always there, right? If you look at venture capital, it sits within the alternative investment portfolio of an investment thesis, right? Like you got hedge funds and you got real estate and you got stocks and all this stuff. But venture capital, if you look at it, is inherently one of the riskiest alternative assets out there. Why? It's not liquid, right? One, it's not immediately liquid. It has a long time horizon. Valuations fluctuate up and down as we've seen in the last couple of years. And it's very risky in the sense most startups eventually fail. And so that's where it started. I think somehow it was always around, like I think if you look at the 1800s, right, that's where it started. There was a whole Thomas Edison and Nikola Tesla highlighted examples of early technology investment. But I think where it got popularized was towards the dot-com boom when people started to see how this thing can explode. But because of venture capital, if you didn't have people investing in risky bets at the early stages, finding those innovators who have crazy ideas, who think they can change the world, right? Change the way people do things, but they don't know how they're going to do that. But nonetheless, they make the bet, they sacrifice their life and they go all in. They make promises that they don't know how to keep, but they do their best to keep them anyway. If you don't have people investing in that, we wouldn't have Apple and we wouldn't have Uber and we wouldn't have Airbnb. We wouldn't have all the facilities that we enjoy in the world today, right? I think that's where it started. And if you look at it, the dot-com boom came sort of proliferated the internet and then the cloud. Then came mobile, right? If investments didn't go into mobile apps wouldn't be in our hands. And then came now, like, fintech after mobile, right? So you got internet, cloud, social, mobile, fintech. And then today we're at the forefront of AI where at the snap of your fingers, you can get anything done. I think without VCs funding this, high risk, you wouldn't have some of the craziest innovations that we enjoy today. You just have brick and mortar businesses that are doing traditional things and generating marginal returns. But anytime, and you know this, any industry where there's a pot of gold at the end of the rainbow and everyone's chasing it, there's just also going to be a lot of bad apples and scams.
Yeah, I mean, I guess if I wasn't so close to the industry, if I was just any consumer, I would love this, right? Because as you said, like I didn't really think about, the amount of innovation that comes out of this. And that's why the US has always been that hub of innovation. There's so much money being dumped into looking for this innovation, right? But I guess for the sake of this podcast and this conversation, like it just leaves a trail of destruction also that no one ever talks about, no one ever sees. And now that we're in the industry, a lot of them are also our friends. But let's also rewind a bit to like, where did this term unicorn come from? Like, how did it become this sensation that we're all chasing now?
Collateral damage is part of doing anything great. Unfortunately, whether it's your family, your health, the industry, right? Things happen. And that's the unfortunate side of things. But the unicorn term, Eileen Lee in 2013 put out an article in TechCrunch, which specifically read, I wanted to read the title, Welcome to the Unicorn Club, Learning from Billion-Dollar Startups, to describe sort of the rarity of privately held companies that reached $1 billion in valuation, right? It was so rare that they compared it to a mythical creature, a mythical character that you can barely find. But what happened is anytime you put a goal there publicly, unicorn, people try to achieve it. And I think by 2015, her team found an increase of 115% in the number of unicorns since 2013. So the number of unicorns ended up in 2015 being worth 327 billion, or 2.4x their previous estimate. And if you look at it coming out of the pandemic, depending on whether you look at CB Insights or Crunchbase, it's somewhere between 1,200 and 1,900 unicorns. If everyone's a unicorn, if you're minting a unicorn every day, I think during the height of the COVID boom, it was 1.5 unicorns were minted every day. Is it mythical? Is it rare?
I mean, do you think when Eileen coined this term, that she thought people were going to aspire to it? Or do you think the original, intention was to let people know that it's rare and that's not you? And then it went the other way.
Eileen, I have a lot of respect for her. I don't know her personally. I follow a lot of her content. One of the pioneers in early stage investing. And if you see what happened from the early days to somewhere around the 2010s is this seed and early stage investing accelerators started to proliferate, right? And you started to see now micro VC funds with like 10, 20, 30 million, $30 million investing at the earliest stages. This was needed to fund these ideas. And that happened coupled with the cost of building startups also went down, right? With the proliferation of the cloud. And now you don't have to stand up servers. You can just put something on AWS and you can have easier, cheaper distribution tactics. So I think what she's done for the industry is phenomenal. But also, nobody puts out a term if they don't want others to adopt it, right? You call something a unicorn, everybody will want to be a unicorn. You're saying basically the mark of a successful startup is to attain a valuation of $1 billion. You already have a bunch of founders who've left everything on the line to pursue their dreams. Now you've given them a benchmark. The benchmark is no longer an exit. The benchmark is $1 billion. Everyone wants to be $1 billion company. Didn't you want to be one at some point till you realized the sacrifices it took?
I mean, yes. The short answer is yes. And I wonder if this is more of an American thing because there's business idols, right? It's like special to America, right? Where we like worship Elon Musk, right? And talk about Jeff Bezos and Mark Zuckerberg like in news headlines, like it's gossip.
But you see the thing there, right? Is with Bezos and Elon Musk today and some of these big leaders like Coca-Cola and Pepsi and all these Nike and pioneers, they're so big that it's not immediately relatable to you and I.
Yeah.
But when you see this valuation jump to $1 billion, right? And in 2013, there were a handful of them. And by 2015, there were dozens. And then you hear your friends and your friends' friends are all turning into unicorns. And you see it during the pandemic. Actually, the correct stat to read here from Crunchbase is 1,484 unicorns have raised $906 billion and are worth $5 trillion combined. And CB Insights counts 1,220 global unicorns worth $3.83 trillion. So very close, right? Depending on the stats as of today coming out of the pandemic. What they don't talk about is how many of them actually are now undervalued because the market corrected itself. But nonetheless, when you put this target, when you look at Nike, like all my life, I admired business people. I always wanted to be an entrepreneur as a kid. But like admiring Nike and Harley Davidson and Apple, you don't feel that connection. You know that. But when you see your buddy from Y Combinator get $1 billion valuation,
yeah.
And you see another friend's friend is at $1 billion valuation and everyone around you is the unicorn porn club. You're like, yeah, I can achieve it. It becomes all of a sudden believable. And the first step towards achieving is believing. If your mind can believe it, your body can achieve it.
But I mean, the crux of that problem is you can't even raise money from VCs unless you can sell the $1 billion dream. Like, don't even come in the door. Like, that's part of the slide deck.
100%, right? Up and to the right, the VC math is a triple growth and then double to get to that unicorn status. But if you see, once you believe that you can build a unicorn, then you start believing in the vision. And then you start believing in this growth plan you created in your head. And I think to some extent, all founders need to, in the beginning, lie to themselves because the journey is going to be very hard. The key is you're not lying to yourself so much that you're delusional and it's rooted in some truth. And folks, we have a whole episode on this con artists in the boardroom.
Some people are are delusional. Not all, but
Not
some.
all. But to some extent, you have to delude yourself, right? Like, think about it. It's like akin to hopping off the plane. Like, you're going to skydive. I have a great fear of heights, but I did skydiving once just to conquer it. And I had to convince, and I was the last person to go. And I had to like say a bunch of stuff to myself to jump, and they kicked me out anyway. Now imagine I had to jump off that plane and build my parachute on the way down. That's what doing a startup is. To some extent, I think you have to tell yourselves certain, I guess, self-inspiration, or, if you stretch it, it ends up becoming a lie. But nonetheless, you have to, if you want to play this game. But I think what happens is the whole incentive model with the VCs causes a bit of a misalignment, right? So investors, these VCs, in general, they invest other people's money, OPM. And who are they raising money from? Wealthy individuals, and more importantly, large institutions, endowment funds. And they're getting paid a commission, like a 20% on the increase in value.
It's like everyone has a boss.
Yeah, increase in value. Now that boss, having your LPs as your boss, is not as bad as having a boss at work. But nonetheless, so you have this, and now you gotta meet this expectation. You've promised them that you're gonna generate an outsized return. We already talked about how venture capital is the riskiest asset class in an investor's alternative asset portfolio, right? They can invest in an index fund, right? If you look at some of the best index funds, they're up like 20, 30% year to date. On average, the S&P 500 returns 10%. So I can just stash my money in the S&P 500 for 10 years. Why lock my money in a venture capital fund for 10 years if it's not going to return me an outsized return? That's the number one thing. So in order to deliver that outcome to my LPs, I got to only invest in startups that I absolutely believe in, fits my thesis, and will give me the confidence that will return that kind of money. Now, 10 years ago, and maybe up to 5 years ago, pre-pandemic, that number was $1 billion. Right now, I think the investors are looking at it as, can this be a $5-10 billion company? Can it return the whole fund? They don't do portfolio theory, right? They're not saying, okay, Melissa's company will return 100 million and Lloyd's company will return 3, and then I'll find 4 others and I'll do the math of $1 billion and give it back to my investor. That's not how it works. They know at any given time, any company can fail. So every company should be a multi-billion-dollar company. That's the math. So when you go through an accelerator, talk to an advisor, they're coaching you on pitching to that. That's the reality.
I mean, I've also been in that position as well, where I was coached.
Yeah.
Even though I didn't believe I could get there, I was told what to say.
Exactly. You're told exactly what to say. You're a naive founder. You go through an incubator, accelerator, and they focus on the pitch. What they don't help you understand is what the journey is going to be. Getting the money is so glorified in the media and the tech crunch. The media has perpetuated this addiction to unicorn porn, right? Every day you'll see X company raises Y funding at Z valuation. Why is this headline every single day? So when you make headlines like this, founders feel they need to aspire for X company raising Y money at Z valuation. That's what they're aspiring towards. But what they don't prepare you for is the journey you need to go on, which is a hard one. And if you just ask yourself, hey, what is my personal definition of success? Not money, but what are the things I would do if I came into money? And how long do I see myself doing that? How much money do I need in my bank account to fund that lifestyle that brings me joy? And is there a version of this company that I don't want to work for? And be true to yourself. Sometimes you got to fall through pain, but you may say like, man, I'm just happy working with contractors and nomading around the world. And I don't want to have a boss and I don't want to be answerable to a board. You know, the dynamics of running a venture-backed company, because I've only ever worked at venture-backed companies before starting Boast. And then Boast was bootstrapped for the longest time to 10. And then, of course, we sold half the company to a growth equity fund. And then the dynamics change, right? Now you are in this relationship, and I would say it's a marriage, because building a company is a long slog. So you have others at the table. And you may say, oh, I'm the CEO or I'm the president or I'm the founder, but you're answerable. You're answerable to shareholders, customers, and employees. And you got to play that. And so if you're not signed up and cut out to go for this 100%, you might be making a mistake, because the worst is to lie, right? To lie to investors and take their money, and to lie that you have the motivation and keep it going to exhaust the money and then eventually shut down.
I mean, for the sake of today's topic, right? Is it a Ponzi scheme? Like, in which way? So just to define what a Ponzi scheme is, it's like multi-level marketing, right? It's like the early investors get cashed out more because they were early and they found later investors. Like it seems like it kind of happens in the same way, right?
Any risky idea, right? Basically the definition of a Ponzi is you're investing in an enterprise and you keep bringing on new people with the promise of increasing their value, but there's no enterprise. So it's borderline, right? Now, every everything done with bad intentions will be a scam, unfortunately. And the startup world has seen so many, like Theranos and WeWork.
That's not the norm, though.
That's not the norm.
There are out there.
But nonetheless, the VC math here is this, right? Most VCs, before they exhaust and liquidate the current fund, they end up raising a second fund and a third fund. They're always fundraising, right? So what they need to do is show on paper the value of their portfolio is growing to their LPs. I'm an LP in 10 funds, so I may not be the biggest investor in the world, but as an investor in 18 startups and an LP in 10 funds, I'm getting hit up a lot. And many times by my same VCs that, hey, do you want to come into the next fund and the next fund, etc. So I'm seeing this, right? And what I see is everyone's portfolio is growing. Everyone's portfolio value is growing, but there's no liquidity yet. Of course, the time horizon is 10 years, but there's no liquidity yet. Now, on the other side, being an investor in startups and being a board member in 3 startups, I see the other side of the coin. And the other side of the coin is this. Silicon Valley and venture capital, right? You raise your first round of funding. The value of that company increases when you bring 2 more suckers in. just tongue in cheek here. And the value of those 2 more suckers' equity increases when they bring a few more suckers in. And sometimes before the reality, which is profits and revenue, come into play, they exit to the next sucker, right? And so is that a Ponzi scheme? So I'll give you examples like a friend's company, right, was about to go under, and they had a very valuable asset in their customer base, and a bigger company wanted to acquire them. But here's the catch though. This bigger company, this bigger startup is it's 10x overvalued because they raised a massive round during the pandemic, okay? And now, what is the dilemma here, right, for investors? Should we encourage the founders to sell and convert our money into stock in the new company? Because there's no liquidity here. This exit turns into stock for the investors. So we get stock in an overvalued company. And there was a lot of leftover cash in the bank. Rather than returning a meaningful portion to the investors, would rather take stock in that company. Although that company overvalued, there's enough unicorn porn buzz around that startup. That's a good signal to our LPs. I've asked this under the table or behind the scenes to these investors, and they're like, oh, rather than marking down my portfolio, I would now show a markup, an increase in value for my shares.
Because it's also good for the founders to be acquired instead of shut down, right? I mean, is that the other option?
The other side of it is, yes, it's good for the founders to be acquired, but ultimately as a founder who's built a company on other people's money, your number one responsibility is the shareholders. Just because you're going to shut down, taking all stock in a company that is grossly overvalued and is running out of money is going to take all the investors to potentially zero. Now, there might be a Hail Mary, and down the road, they may be able to raise money, but nonetheless, you're risking people's capital. As a founder, unfortunately, you get to make the decision for yourself last as a venture-backed founder. And there are rules around that, right? That's why there's preferred shares and common shares, and the investors are made whole for the most. But nonetheless, when you have cash in the bank and you're trading that cash for equity in another company, and that other company is overvalued, you have a fiduciary responsibility to ask yourself, is this the right decision? But here, the investors were encouraging that decision because they saw the Ponzi carrying on. They'd be like, hey, rather than showing a markdown and one of our companies shut down and getting a marginal amount of money back, we get a second kick at the can, and now we got stock in a grossly overvalued company. And to me, that is...
But why do they want stock in a grossly overvalued company if it's going to run out of money?
Because who knows? There's enough people around the table and pedigree that they'll keep it running. There are some big ideas, as we know, right? If funding to some massive companies that we see today, like the Ubers and the Airbnbs, were shut at the early days, they likely wouldn't be where they are today, right? Big ideas sometimes take big capital. And so the hope is it's a big idea. There's enough good people around the table that they'll give them more runway until they figure it out. But nonetheless, it's a risk. But the key here is you want to bring more people, because selling stake in a company to more people at a higher valuation shows the increase of value of your portfolio. And to me, if done in sort of, what do you call it, like shaky metrics, then it's a Ponzi scheme.
I mean, I know we're talking about big numbers here, but this happens at the first check, right? We talked about accelerators, right? Like I was in an accelerator. I quit in the first week because I realized I didn't actually need them. But think about any accelerator that you apply for. What do they want, right? They give you 50, 100K for, 5%, like something ridiculous, right? And then your valuation would be 3 to 5 million. But their entire existence is to get you to demo day in front of 200 other investors in their circle so they can sell you, like prep you, put on a dog and pony show so they could sell you and your company for 10 million. So now they've doubled their own investment.
Or sometimes, during the pandemic, and depending on the brand name of the the accelerator even tripled, quadrupled, right? I think the metric for most accelerators, and this is what creates sometimes misalignment, the metric for most accelerators is not company getting to X traction or X revenue. It is how many companies that got out of the accelerator raised a follow-on round of funding. And
But
I
that's
know
the
this.
sell.
I
That's
know
how they
this
get you in.
because I show up at these demo days and I have friends who run accelerators. So people who challenge me, maybe there's a couple of accelerators who have different metrics, but the vast majority have this metric of the number of companies that leave the accelerator that have raised a follow-on round of funding at a higher valuation. And this needs to change. You see what happened during the pandemic, right? I think this is very important to break down in the grand scheme of unicorn porn and when you look at what a Ponzi is. During the pandemic, everything went offline. Businesses had no option but to transact online, right? They need to, brick and mortar needed to transact. So you need what? Twilio, you need Shopify, you need Zoom, you need Snowflake, you need these tools. Startups started seeing obscene growth coupled with the US lowered the interest rate. The interest rates tanked to zero. So now startups started seeing investment interest. Oh, you're seeing obscene growth. What people refuse to recognize is this is a black swan event. Everything's shut. So, you needed to supply them with connectivity. But people ignored this. There's this black swan event. People just assumed that, the market grew and they're going to keep seeing the same growth year over year over year. It was just a temporary sort of adjustment to the new reality. And things were going to normalize to where it was before anyway. But seeing the low interest rate, a couple of hedge funds like the Tiger Global and SoftBank, they came into the market and started investing heavily because they're like every recession. If you look at 2000 and you look at 2008, coming out of 2008, you had Uber and Airbnb. Every sort of situation like this, black swan event, leads to a big company. We just need to spot that one big company. If the rest of them fail, it doesn't matter, right? That's the reality. And so they're gambling, but the downside of this gamble is carnage. A company shutting down, layoffs, like 35,000 layoffs, according to layoffs.com or layoffs.fyi after the pandemic or in the last year. And so they started investing frivolously in these companies. And when Tiger, I think every year was doing sub 50 investments. And during the pandemic, over the 2 years, they may have done like 250 to 400 investments. So I think leading up, they did 40 over the past couple of years. And over the 2020, 2021, they did 400. They had a third-party consulting firm or two do all the due diligence and they just show up with term sheets. They invested $100 million in a friend's company, and that friend did seed, series A, pre-seed, seed, and series A in 3 months, $100 million. That company doesn't even have $2 million in revenue. These companies are all now worth $300-400 million. On the founder side, here's the math. When you raise from an accelerator, let's say, and you're $3-5 million in valuation, what does the investor want at bare bottom? Make 3x. You can sell the company for $15 million. Lots of those deals happening. When you raise at $20 million, bare bottom, lots of deals happen at $60 million, $50 million, right? When you raise at $300 million, what are you signing up for? You're signing up for an IPO or $1 billion exit. How many of those happen every year? You can look at the math, right? That's the journey you're signing up for. And 2022 rolled around. And 2022 rolled around and these people couldn't keep up with their growth projections. And the market crashed in conjunction with the interest rates going up. Every time the interest rates go up, the market readjusts. The interest rates kept going up and valuations kept falling and falling. Now you got a bunch of startups that are overvalued. They've blown through a bunch of cash. They haven't met the valuation for which they raised because you're always raising as a startup at like a 12-month down the road, 12 months post 12-month growth rate, or rather traction at the end of the 4-12. And you're raising at that valuation. So you're not worth $1 billion, but you've taken money like you're worth $1 billion. And if you have a down round, meaning you need money to continue to grow or to continue to fund your company to just operate, and you go to the market, you basically just wipe out your cap table or you massively sort of deprecate your holdings in your own company, right?
But it's because of the Ponzi scheme, right? It's because, say, for example, let me just play this out for you. I go into an accelerator and I am successful in demo day. Yeah. So I take money for $5 million valuation. I then raise more money at $10 million. I don't get to product market fit, but I don't want the company to die because I raised from a brand name VC. I asked my VC to help me, but I need more money. But that VC doesn't want to put in more money because I don't have the product market fit. So this VC now gets a friend to put more money in because I'm in their portfolio. And it happens again and again and again.
I was that friend to at least 2 accelerators, like just fund them. And trust me, they're good founders.
My revenue doesn't keep up, but at some point I'm no longer fundable because I don't have a real business, and I've raised capital with my 10 slides every single time with the help of my VCs. And what happens? What are my choices, right? Do I shut down? I IPO, or I find another sucker? Like, what happens there?
IPO is not an option, right? You barely have any traction. You're not growing.
I mean, let's say at that point, I have so much money's been pumped in, right? Say I've got like 10 million in revenue, but I've raised, 50 or 60.
You raised 50 or 60. And here's the thing. Here's a valuation, real predictor of valuation. Your growth rate, how fast you're growing, in conjunction with your gross margin, in conjunction with your profitability, right? And your retention. All those things have to check out, right?
Eventually.
And eventually could be now, right? Think about it. If you have less than 100% growth rate or less than 80% growth rate at 10 million ARR, and your gross margin is like 50%, and you have like a 5% churn, eventually is now for you at the startup. Who's going to fund you? You're going to have to do your best to convince another sucker, and that sucker needs to come at a little bit higher valuation than the last round, or else you're going to have a down round and your value of your holdings in your own company is going to significantly go down. So to me, those things, are to me borderline Ponzi, right? In the sense, as a founder now, what are you faced with? There is no clear path to get traction, because if there was, you would have seen it and you would have done it. You also know that you took a higher valuation than you should have because you got punch drunk in the founders market during the COVID boom. So now what do you have to do? There's two sides to everything. You got to lie, and you are lying. Right? Because I've seen now that this is what the media doesn't talk about. There's many friends I know who are overvalued. They're selling assets in their company. There are many friends who are quiet shutting and nobody knows. There are some that have lots of revenue, 100+ million in revenue, that had glorious shutdowns, or quiet, like sort of semi-quiet shutdowns where only
But nobody reports on them, right? That's why we only look at the glorious money raising, but nobody ever reports on what happened to that company in the end.
What shocked me the most, because this is not a Hopin or a Juicero or any of this. What shocked me the most is InVision. I had been using InVision for UX at Boast in the early days, at Speakeasy, and during the pandemic, they raised at 1.7 million, and they got the email last week that they're shutting down the product. That was, to me, that was as real a company, right, as anything else, because it didn't come up during the COVID boom and just suddenly raise at a high valuation. Like you look at Hopin now, they were an online events platform, virtual events, right? An alternative to Zoom, a better, sexier Zoom. But they raised as a massive valuation. I think the founders, and this is probably never going to happen again, but the founders took tens of millions off the table in secondary, negotiating with these hedge funds who started VC investing, because
they were the hottest thing for a hot minute.
And then, the smart thing Hopin did was, during their run, they acquired a podcasting service called StreamYard. They've now, I think Hopin is not even around anymore, and StreamYard is driving the business, right? And so these are things you got to be careful, man. Building a startup is a long slog. It's not a one and done event. It's not a black swan thing that you can do in 2 years. I think a lot of founders wanted to play the lottery, and it's two sides to the dance, right? The investors, the advisors, the accelerators make you feel this way. All of a sudden you're hot shit. When in our lifetime in the last 10 years did founders ever become so hot shit that not only investors wanted to invest in them or fight over them to invest at the highest possible valuation, but then you got banks like SVB coming to them and saying, you know what, you're not making profits. It's okay. You have so much venture capital. I'll give you matching debt. I'll give you venture debt. What happened to SVB?
Yeah, I think it's ironic that a lot of these companies that we don't hear about are sold as success stories. And then we like the acquisition you just talked about. It's going to be, I don't know what company that is, but it will be sold as a success story. And then there are many, many founders that now aspire to that story. Because in the beginning you said something that really resonated is, now it's relatable, right? We don't relate to Elon Musk, but I know this guy and I can kind of do what this guy is doing, right? And that's, I think, the danger, and that's what creates this completely twisted idea of success, is the idea that you can be that person too.
You are a victim of your environment, right? We say you're a victim of your circumstances. You're a victim of your environment, who you surround yourself with, who you idolize, right? The thoughts you put in your brain. It's like the time, Napster was illegal, right? But everyone was downloading it.
Yeah.
Everyone was downloading
I mean, it was
music.
awesome.
It was awesome.
Yeah.
But you know what? If you were the only one doing it, you'd have the fear of God, right? Like, I'm doing something illegal. But if you and your entire circle is doing it, it's not illegal anymore. So if you and your friends and everyone is raising at the highest valuation that you know, and you think this is going to keep going on, it's normalized. And now all of a sudden you're like taught to do FOMO tactics and valuation negotiations. I think the reality of the situation is great businesses are built on alignment around a vision, purpose, mission, and values. And you got to think about longevity. You may get lucky and maybe turn into an Instagram, but most businesses are not going to be. When you raise at a very high valuation, what you're signing up for is that I need to grow into that valuation. And now you're making it deliberately hard for yourself. So what you're saying is, I am going to meet that valuation in the next 12 months. Like, why would you sign up to launch yourself into outer space when you don't have to, right? You can be reasonable. Because here's the thing, a valuation is such a game that when you actually get to a certain point, you can command that. Why would you artificially infuse it and say, no, my company's worth 40x? Eventually the market will correct itself. But a lot of people are getting the wrong advice. And what's worse than getting wrong advice for founders is actually investors driven by FOMO and market dynamics honoring that valuation. And all of a sudden now it's real. But now to keep that charade going, if you don't have the metrics, what are you left with? Bring somebody else to invest at higher or the same. Bring somebody else to invest at higher or the same. Bring somebody else. Bring somebody else. And that to me is a Ponzi scheme. And then eventually you exit before the company producing meaningful profits and being sustainable or IPOing. And so if it's predicated, if your business model is predicated on bringing in other suckers to increase the value of this enterprise, then that's inherently a Ponzi scheme.
But what happens to all those startups that just burn through millions, hundreds of millions, leaving nothing behind except for scorched dreams? Like, do they cash out? Like, this is me as a founder wondering, like, is it good that you raise hundreds of millions? Like, so then you can maybe pay yourself $1 million salary? Like, what's happening?
There's a board and
founders?
there's accountability, and most founders, in most cases, need to disclose how much money they're taking for the company.
What's acceptable? Like, what is an acceptable salary for a company that's raised like 50 or 100 million?
Market rate for a CEO, founder, C-suite at that stage, and there's benchmarks that you should Google. But at the early stages, it's almost no money, right? And you raise some funding and you pay yourself nominal. I think Alex and I were paying ourselves $5,000 a month.
But you weren't VC funded.
But when we paid ourselves, when we took the money, growth equity, which was, of course, to liquidate us. We sold half the company. We had bootstrap, but nonetheless, we stayed on for a year or so. After that, we paid ourselves market rate for that role. And because you have a VC at the table, they have benchmarks because all their portfolio companies hire. So you benchmark against the norm, not the anomaly, and you pay yourself a market rate, not above or below.
But are they also selling their shares in secondary? Or are new VCs not letting them do that?
If you are in a founder's market, then it's demand and supply. You can do whatever. We know tons of founders that got lots and lots of secondary, right? And that is different than selling your company or selling a portion of your company. That is like taking a lot of secondary at the early stages, which is horrible because you have no traction, or you barely have any traction, or you have a short-term traction.
But would you call these companies early stage still? Like, we're talking big numbers here already, right?
Just because a company raised 100 million doesn't mean they're late stage, because what matters is you barely have any customers and you have 1 or 2 million in revenue. If you have 1 million in revenue and you've showed some user growth and you're B2B SaaS and that user growth got you 100 million in funding at $1 billion valuation, are you late stage or are you early stage? I think the stage depends on when you've started and how much traction you have, both in terms of revenue and customer growth. In B2B, it should always be revenue and retention and gross margin. And so I don't care you raised $1 billion. If you don't have paying customers, you're still early stage, right? And then at that stage, say in your seed or Series A, we've seen like $100 million Series A rounds. At Series A,
not anymore.
Yeah, not anymore. But if at Series A, where you barely have any revenue, maybe say you have 1 million revenue, at Series A, you raised 100 million. And because there are 5 VCs fighting over you because you're hot shit based on not revenue, but based on customer traction. And think about it. Customer traction was not very hard to show during the pandemic, right? Everyone was locked in their room. They needed to do stuff online. So you showed like, oh, look at my product usage is through the roof. When the reality hits and everyone can go out again, then you look back at your numbers and you're like, oh, dude, my usage has gone down like 80%, 60%. then, right? But nonetheless, on short-term metrics, because that short-term wasn't so short-term, it was like 2020 and 2021, they were able to raise large amounts and large sums at high valuations. Nonetheless, you're still early stage. To me, if you are less than 10 million ARR, you are still early stage. You're not growth stage. If you're 10, 20 million ARR, to me, you are then in that growth stage.
Do you think everyone can play this game? Like, could anyone just walk in and raise money and get into this Ponzi scheme and try to cash out and pay themselves big salaries?
It's a game of network, right? They say this, I love the saying that I made up, which is your community is your currency. But the age-old saying is your network is your net worth. Why do you think Elizabeth Holmes lasted so long? She had a network, right?
Probably a great salesperson too.
Great salesperson. When a great salesperson meets a great network,
Unstoppable.
magic happens, right? Like I think Benchmark Capital's Andy Ratcliffe had this comment that says, when great founders meet great markets, magic happens. But when bad founders meets a good market, the market wins. When a good founder meets a bad market, the market wins. And when a great founder meets a great market, magic happens. But it's the same way when a great salesperson meets a solid network, people believe in you because you've delivered, you've established a circle of trust, right? And so this is much like hiring also. Think about this very deeply. I have funded you because I like you, I believe in you. There's something about you, right? That's the belief. I believe in the founder at the early stages. That's why referrals are so important in the VC world. A lot of deals happen through referrals because it's a circle of trust. They want to know if you can execute. You have a big vision and can you execute? And if they get a cold email or they don't know you from Adam, they don't know your ability to execute against the big vision. And again, they need the big vision because the big vision does their outsized return, right? The triple growth and then the double growth. Now they've funded you and the founder then is struggling, but the founder has to show a strong face and lie to himself and lie to the VC. And the VC is like, I've invested, but maybe I'll support them some more. Let's see where they go and where they go. You know, sometimes it's like Asian parents, right? You got to finish everything on your plate.
Yes.
Rather than
like your parents.
Yeah, my parents, rather than throw it in the garbage. We never look at something as sunk cost. And one of my key learnings in the last couple of years is to spot sunk cost and cut my losses versus keep investing in that hoping it'll change. You really, building a business is part emotion and part data. That's why you can't do anything and operate off an Excel sheet and hope it plays out, right? Everyone has a plan until you're punched in the face. It's going to be part emotion and part data. As a founder and as a VC, it's important that you balance that. Sometimes you get very, very emotional. It's very important to look at the data and see, like, if they've not achieved product market fit, what are you going to do specifically to get there? What are the actions? And if you can spell out the actions for me, because it's all an experiment. See, the conversation becomes very calm when you word it like an experiment, right? I'm going to do X set of things and my hypothesis it'll generate Y result. Okay, let's run that experiment for a quarter. Okay, it's not working. Then another quarter. And then it's like, okay, we're running out of money. You've done 3 experiments. I've not seen anything. So rather than funding it, we're going to move on. Magically, you're not going to come up with an idea, right? Because if it's like running a science project and saying, okay, we abandoned this idea, now let's move on to the next one and the next one. If you're pivoting every quarter, I think putting a tight timeline on things is very important. I think most ideas can be validated in 6 to 12 months. Product market fit maybe take 12, 18, 24 months. And then figuring out a repeatable channel maybe take another 12 months, give or take. And if things are taking excessively long, like then as an investor who's given you money or board member, you gotta ask, like, why is it taking you so long to validate? How many customers are you talking to? Some people just say, okay, I'll build it and they'll come. And it never happens.
So what is the solution, you think, for founders who, I mean, I don't know, maybe some people are listening to this thinking, I love this, right? And they should go and pursue it. But, maybe some founders are listening to this thinking, okay, how do I avoid this trap of getting into the Ponzi scheme?
I know many founders who love this. And I know, of course, I lived in Silicon Valley for 15 years and still home for me. And they'll know when I, as I'm saying this, but I won't take any names. I know many founders who deliberately play this Ponzi scheme and keep going from 1, 2, 3 startups. And then eventually they become an angel investor or an advisor. And they go from preying on investors because they're such sort of sociopathic founders. They go from preying on investors to now preying on the market and founders, and they end up becoming a VC or they become an angel or they manage other people's money in a small fund. But nonetheless, I think the path here is this, right? You got to ultimately build everything on trust and think and internalize that with your founding team. Building a company is a long slog. And the only way to build a sustainable business for the long haul is to focus on customers and employees and revenue and profit. That's it, right? And so I think if you look at Zapier, one of my favorite new age companies, they only took YC money. They're worth $5 billion. When I'd interviewed the founder, he had said something like, money should be taken only when you need it to solve a problem, not to fund some future aspiration, right? You leverage your money from customers, not from investors. And that's a good thing. That's like saying hiring, right? Like a lot of big company folks, they join your business when you raise money and they only know to hire one way, which is there's a goal and now I need a hiring plan to meet that goal. It's never like fill the gaps and stretch myself. So as a founder, I think you got to think to yourself, what are the stages? I need to validate the idea. Do I need money to validate it? Let me figure out myself. Why do I need money to validate it? We're in the age of no code and generative AI. Product market fit. Do I need money to get to product market fit? So you got to ask yourself at each of the stages, do I really need money? And focus on getting customers and delivering them an outcome. And then take money only when you absolutely need it. Two things happen when you do that. More businesses die of indigestion than starvation. So you don't get frivolous, right? Constraints lead to creativity, number one. And number two, you keep more of your company.
I mean, the thing that I love about bootstrapping is it forces you to build an actual sustainable business, right? You don't have the luxury of wasting money and not listen to your customers and build a product that creates economic value. It forces you there. And I know I'm an avid bootstrapper and I talk about this a lot, like multiple times a week on LinkedIn, but I actually don't know if I will ever take money in the future. I say that now, but what I do know is if I ever take venture capital, it will be on my terms because I want it to accelerate a company that I can't do myself. But right now I'm building a company on customer revenue, the best kind of funding, to figure out who I want to be when I grow up. I'm not going to take someone else's money to figure out who I want to be.
Exactly. And a lot of people, they take money because the media has normalized it to help them figure out who they want to be. Now, in some cases, you absolutely need to do it. On the Traction podcast, I interviewed Keith Raboy, Nextdoor, Open Door, PayPal Mafia, one of the top investors on the planet. And he says, building a startup is like making a movie. To make Avatar, you don't go and ask the market and sell to customers. You cast a big vision, you raise finances for it, and you produce it, and then you cut a great marketing campaign to sell tickets and put butts in seats. That works. Those are the PayPals and the LinkedIns and the Ubers of the world. But those are anomalies. How many startups end up changing the world like that? Not many, right? A lot of startup ideas start by sort of being marginal improvements on their own personal pains or a 10x improvement. But that doesn't mean that's the TAM of 10 billion or 100 billion or a trillion, right? So I think that is key to ask yourself. And there are other routes. Bootstrapping is one. You can also bootstrap to 10 million in revenue and then look at growth equity options. And a growth equity investor doesn't want to see a triple, double growth. They want a 3 to 5x their investment in 3 to 5 years or 5 to 7 their investment in 5 to 7 years. And so their growth goals are not grow 100%, 200%, but more 30, 50% maybe, right? As long as you have high retention. There is government funding, there is crowdfunding, there is friends and family. And your friends and family will not want a 100x return. If you raise money from friends and family, they may say, you know what, I'm going to put 100,000 or 10,000. At the end of 10 years, if you pay me more than market, like the market, if I put it in the S&P 500, I get 10% year over year. At the end of 10 years, if I get 20% or 25% or 15%, maybe I'm happy.
I mean, I will say that for most businesses, if you think that the reason you're not successful or the only reason you can be successful is venture capital, you're probably looking in the wrong place. Like friends and family funding, loans, side hustles, right, to fund that can get you pretty far, at least until revenue positive, and then you can kind of figure out what you want to do.
100%, because when you take VC money, a lot of people say, oh, I'll take VC money. You might not fit that profile outside return. I mean, we already know the math, right? We know the math that they need to generate an outsized return. You need to be 100 bagger. So a startup needs to show like triple digit growth, double digit growth. That is hard. That is very hard. To grow 100% at 10 million ARR is very hard. How many companies are doing that? And if you can't show that, then why are you even wasting your time? If you're at like 1 million, 2 million in revenue and you're not growing 200% or 100, at least 100%, but definitely like, somewhere in that 100, 200% percent range, you know VCs are not going to be interested. So why are you even wasting your time? Just do yourself a service and run your business, get more customers. You'll be happier and you won't be stressed out. The worst is going on a journey where you know you're going to get a bunch of no's. It's like, I'm going to hit this club, which is all a bunch of supermodels, but I know like everyone is going to tell me no. So I'm just going to go and set myself for disappointment. Just know your reality, right? Don't delude yourself into thinking that you're going to get something when your metrics are clearly saying the opposite.
I mean, we know how many companies are 100 million. It's 150.
Yeah.
Only 150. Like, how many startups were founded in the last 10 years? But only 150 companies are true unicorns, right? 100 million in revenue.
And that is in terms of the SaaS, right? We're not even looking at the B2C scape, which is B2C. Failures are a lot higher, but also the upside is also huge, right? See, the venture capital world traditionally invests in the riskiest bets. It's not liquid asset. It's tied up for a long time. There is fluctuations in valuations and high chance of failing. But it also produces the Ubers and the Airbnbs and the Googles and the Apples of the world. But if you look at what's happened here, I think we read the stat was like, let's call it 1,400 unicorns. Only 150 have 100 million in annual recurring revenue. I think that's the stat from Bessemer Ventures, and that's the stat from Salesforce recently. That just tells you maybe that the benchmark of your valuation is not some obscure number, some VC or some founder slapped together based on market dynamics of demand and supply. Really is like, am I a business that can get to 100 million ARR? Am I there? How close I am? And that should maybe be a benchmark of your valuation. I think Bessemer Ventures called it Centaur, like cent for 100. And I think there was a mythical character called Centaur.
Yeah.
Right? And so it's a play on that cent ARR, 100 million ARR.
So Lloyd, what is your one hot take from today's conversation?
I think there's multiple ways to build a successful company. And if you start by saying, and I'm going to raise money and then sell and then raise money and then sell and keep increasing the valuation, you're starting with the wrong incentive structure. You build a business to deliver value to customers, shareholders, and employees, not you first. And if you can't go on that journey, then just know that you're a scammer. If you can't internalize that it's for your customers, your employees, shareholders first, then you're coming from the wrong place. And explore alternative ways of funding your business, right? Pain is the precondition for growth and constraints lead to creativity. Prior to Boast, I only ever worked for venture-funded companies. They all had one thing in common. They had copious amounts of money and they all failed. More nigh of indigestion than starvation.
My hot take is super simple. Just listening to you talk about all this stuff today just sounds like a massive hassle. Bootstrap all the way. That's my one hot take.
This was awesome. Thank you so much. And
yeah, that's it for today.